Welcome to a very special edition of On the Tape. We are joined by the Compound Bros, is that what we call here? So we got Josh Brown, he is TRB, the reform broker, and Michael Batnick, his partner in crime. You guys...
We don't do crimes.
You don't do crimes.
Not
but you know, Danny's out this week. He wishes he could have been here. Parts unknown.
Shout Demo.
But
he's in Italy, actually.
Well, we got Guy Christopher Adami, who came in. Guy has not been in New York City prior to noon.
This is early for me in the city.
5 years.
Did you get called in for this?
Yeah.
For you guys?
Yes.
No, I didn't get called in.
Are you on fast?
Tonight. CNBC's Fast Money, 5 o'clock Eastern time.
Partly for us, partly for
No, but he does afternoons in the city. He doesn't do mornings in the city, right?
So it's tough to get in here.
We had these guys. You guys were on March 30th, and you had a little setup. I was on your pod on March 3rd, and the name of that pod was Dan Nathan Predicts Recession.
Yeah,
that was March 3rd.
How'd it go though?
All right, but then you guys were with us on March 30th, and I think we called it the Compound Bros.
It says stocks will go higher in the future.
Stocks go higher in the future.
And he tried to dunk.
And you guys nailed it.
Thank you for doing that.
All right, so thank you for coming back, because our listeners needed to hear more optimism here. So how are you guys?
I'm getting cautious, but
Short-term cautious.
Okay.
What is short? Let's play the game. What's short term? Like through the fall?
I don't like what I saw in the last 5 trade. This is just me. I'm not speaking for Michael.
No, he's fucking taking my talking points.
I don't like what I saw in the last 5 days. The quality of stocks on the leaderboard each day. It is the junkiest of the junk, and that's fine. It's not illegal, but when that starts, it's not like the beginning of something.
Can I put some meat on Josh's big bones?
Yeah.
Would you mind?
He is big boned.
This is from the Daily Chart Book, who is a great follow on Twitter. It's awesome charts. At Daily Chart Book.
On X. Right
This is from Goldman. Fuck that. Quote, fundamental long-short managers have experienced 9 consecutive days of negative alpha, the longest period since January 2017. So to Josh's point, what's going up versus what's going down, there's a lot of squeezes, there's a lot of delevering, short covering, whatever you want to call it, and that doesn't happen at the beginning of a move. So when we say, or when I say I'm short-term cautious, I'm not suggesting that like regular people do anything. I'm just
you know what this tape reminds me of the most? You know that week the week right after Christmas leading into New Year's, the types of stocks that start rallying for no reason, like China shit and like earnings list companies, stocks that have been down 80% that year and the tax law selling ends, like that. That's what the tape looks like to me.
Well, people
over the last
pushing
few days.
things around, they're just trying to like move things that they know can make some money in short term.
Yeah.
You know what it feels like to me, actually? It feels like Q3 2021. And so when I think about this in the lead up to when the Fed did their kind of about face on rates, you know, we had a last gasp of meme stocks, of crypto, of SPACs, of unprofitable tech, of recent IPOs, that sort of thing. So I kind of feel, I think we feel what you're throwing down. I will say this, you know, we had a great conversation with you guys. You know, Guy and I were, you know, this was, again, March 30th. We had just gotten through this regional banking thing and not really gotten through it. But I mean, I think the dust had kind of settled a little bit because SVB was kind of like room fenced or whatever you want to call it, ring fenced. You know, for us, I think I finished that by saying, listen, if you want to invest in the market right here, and we were talking a little bit about some of this AI stuff, then dollar cost average in the QQQ. All quarter long. Like that's what, like the last thing I said, that's kind of the trade. And that has been the thing that worked, but it has been uncorrected in 4 months now. Like, does that make you guys, even if that's the highest quality stuff, if you believe in that stuff?
So here's a caveat and an asterisk. The caveat is that when I say I'm short-term cautious, again, I'm not doing anything with it, but I'm not calling for anything other than, you know, maybe a 4, 5, 6, 7, a very normal, very healthy sort of pullback. And then the asterisk is that Momentum is very strong. And there was an outside reversal day on Thursday that did not come to fruition. Stocks were up 1% the next day, right? So when the tape is strong, like you got to respect it.
That Thursday was an interesting day, that outside reversal day. Now, the next day, I think part of it was that PCE came in, whatever you want to use term, but also a lot had to do with the Bank of Japan wasn't as draconian as I think the market feared. But that didn't go away. That maybe just got pushed off by a couple of weeks. And I don't want to get all that granular, but that's out there. This dollar yen, the carry trade. I mean, a 40-year unwind might be taking place right before our very eyes. Is that interesting at all?
Well, it's interesting, and it's not to be dismissed lightly like, oh, nothing matters. A lot of people over the years have misconstrued my commentary because I speak hyperbolically and I overgeneralize and I do things theatrically to make a point. So a lot of people look at that and say, oh, he doesn't care, like just buy and hold, ignore everything. Okay, we'll see how that goes. First of all, it went pretty fucking well. But second of all, it's not really how I feel. I think what's important for the context of this conversation is two things. The first is, even if I felt a certain way about the unwind of a currency pair or a commodity price spike or a geopolitical event, the way that we've built the firm is rules-based. We have a tactical asset allocation program. It doesn't run based on my feelings, and thank God, because my gut is not great. At turning points, right? So even if I feel a certain way, the rules that we've set up in advance are designed to protect my clients from every time I have a hunch. That's number one, and thank God for that. But number two, more importantly, I'm also very stubborn, and I refuse to believe that investing today is not going to pay off tomorrow. Even if it sucks for the next 2 or 3 years, you can't talk me out of that concept. So I probably always will err on the side of doing less versus doing more, not reacting. And if anything, my reaction is holy shit, if the market's down 10%, I got to figure out a way that I can buy more. My reaction is not, oh no, it's down 10%. What if it goes down 20? I just don't give a shit.
And I think your point though is also a differentiated one between single stock investing, and the sort of stuff that you're doing on the halftime report or something like that. And I want to get to this, Josh, because you wrote I think a brilliant post yesterday about Uber, and I have not seen that on your blog in a very long time. It was a kind of deep dive. It was on a single stock, but it was more thematic, and you were working some other stuff in there. And I want to get to that, but then let's talk about the inflection point, because our friend Doug Cass over there at Seabreeze, he wrote something about the equity risk premium last week, okay? And it was in the Wall Street Journal yesterday also. And it's not a topic that we've heard in a while talked about here. Talk to me, Batnick. How are you thinking about this? The S&P 500 earnings yield, okay, versus, let's just say the risk-free rate here a little bit. Is this something that works into some of your models here?
All right, hold on. First of all, I'll answer your question in a second. I just want to point out Uber's down 5% right now off of the back of great earnings. So the stock's up a gazillion percent this year.
More evidence that maybe we've gone too far.
So we're a little bit exhausted, which is, again, totally fine. But that's a good point. There's a big difference between trading single stocks, for me, for entertainment, obviously I want to make money, versus my long-term 401k. There's nothing in the world that would stop me from doing that every 2 weeks, even if I got Jeremy Grantham bearish. I would never, because I would take advantage of that, right?
Oh, and I didn't bring that up, and I didn't even see where it was. I brought that up because I haven't seen you write 1,000 words on a thesis, and you were basically part of it was
it was 3,000
You were
words.
saying in two. I only got 2,000. I know, but the point was in 2 to 3 years this stock could double after it's already doubled. So this wasn't a call in the quarter or anything like that.
I know.
I want to be really clear.
So anyway, equity risk premium. Yeah. So what Dan's talking about is the earnings yield versus the yield on either the 10-year bond or tips, like the real, because stocks are a real asset, and it's quite low, right? Meaning that stocks relative to bonds. But of course, this matters over long periods of time, and I think it's actually a great thing, right? The fact that we could actually get income from our fixed income is a beautiful thing. It's been a long time, and so I don't dunk on people that took advantage of that early on in the year and then missed the first best half of the year ever, by the way, for the NASDAQ 100. Did you guys know that? Through July, it's up 44%. Best ever. I don't besmirch or dunk. I think that was reasonable then, and I think it's reasonable now. It's great. So what I would say is now you can get, if you were 70-30, maybe out over your skis, taking a little bit more risk as you needed to, well, great. Now you could dial it back. I think it's wonderful. And yes, I probably would lower my return expectations for the S&P 500 going forward, not just because of where the earnings yield is, but just look at where we've come from. What have stocks do the last 11 years? Up 15% a year? That can't continue indefinitely.
It's also what is the money for that we're talking about, and when are you using it? So somebody walking around in January saying, at that time, I can get 4% on T-bills. Why would I take the risk of the stock market? That was a very rational take then. If that person was planning to use the money a year from now on a daughter's wedding or a college tuition or a second home, it's still rational. It doesn't matter that the NASDAQ went up 40% in your face. You weren't investing with the time horizon or the need to earn 40% on it. So that's the part that gets lost, is that we're not just all investing one giant pool of money that's amorphous and not earmarked for certain things. Like the financial planning profession, we have 20 financial planners working for us. This is what they do. They look at a client's portfolio not just in totality, but in pieces. So it never makes sense to ignore, a yield that's 4%, 5%, now 6%. It never makes sense to look at that and say, I don't need that. I have the NASDAQ.
And guess what? If we're just looking at the S&P to compare the equity risk premium, well, that's 30% or whatever it is. These incredible, amazing companies that should be expensive relative to the rest of the market. Look at what Apple and Microsoft and Google, look at their growth rates, and then you strip that out and then compare it to the market. They should trade at a premium. So if you don't disaggregate that and you just lump it in and say the S&P is expensive, you're doing yourself a giant disservice.
Now, the question is what premium? So I know Michael probably knows this off the top of your head. Josh probably knows this if you were to think a little bit. But how many $150 billion companies are in the world right now? Probably somewhere between 65 and 80. Is that
mostly here?
Mostly here. But I only mention that because a couple weeks ago you saw Microsoft add $150 billion of market cap in a day. Is that concerning, or is that just the way the world is right now?
Well, that got undone 2 days later by the news of the NASDAQ rebalance.
Right. So let's just talk about that. I mean, again, when you see moves like this over the course of hours, is that concerning, or is that just an anomaly?
No, they seem toppy as fuck, and they seem like they're toward the end of something, not the beginning. I totally agree.
But I guess the context is, if the S&P, let's just say the S&P, let's say that this is the high point for the year, which I'm not saying that it is, but let's just say it is. Okay, so the S&P is up, finishes up the year, 16%? We go sideways for the next 5 months. Is that bad for anybody?
But here's the thing that I think is interesting, because what you guys were talking about, the quality of the rally and where we are, is if you look at the S&P was down 20-some% last year, right? And what we know, and you guys know this too, is that investors make lots of individual mistakes, single stock mistakes. They reallocate things at highs or relative highs, and we don't know that they're highs, but you can tell that we're in a period where it feels a bit frothy, right? And then they make really bad decision at relative lows. And we could just look at last fall, where people are puking out. Let's say they can't take it anymore. Meta's down 80% from its all-time highs, 12, 14 months ago, that sort of thing. And it's really hard to make that stuff up. And so I guess when I think about the push and pull between what you guys do and how you think about this for clients and diversification, that sort of thing, and then what we also do a lot of is the single stock stuff that is more gut based, right? And it's more, like animal spirits, to use your fine podcast name, that guy. Why can't you use that expression?
There's certain things I don't say. I don't say.
He doesn't like to say that, but he would say a very fine podcast.
I said it yesterday.
Yes, you did say
Dan,
it.
But there's certain things I say, I don't say hump day.
No.
How was your turkey day?
Yeah, those are not.
Day.
I don't
hump
talk
day.
about
Wednesday. Yeah.
Why do you want him to say
But how do you guys? How do you guys?
Under any circumstances.
No, I don't want him to say.
Dan,
hump day.
what's great? We've got data, a lot of data. Some of it is dated, meaning I don't really care what happened in 19. But what we do know empirically is that people get scared of a bull market, like, oh, things are overbought, maybe I'm going to take profits, seek shelter. Markets, an overwhelming demand for stocks is not a bad thing, even though it might make you feel uncomfortable. Things are frothy, we've got it correct. Maybe we do, maybe we don't. But crashes, real, not 4 to 6, crashes don't happen in good markets. They happen in bad markets. Right?
Yeah.
I know it sounds obvious.
But they do start at the top.
No, but they actually do.
No, they don't.
No, they
what
really
are you talking
don't.
about? Crashes don't start from highs?
No, there's if you are a tactical type of trader.
In what time period though? Because
the big crashes have all started in corrections.
So when really bad shit happens, and I'll do something very simple. The market is generally below its 200-day moving average. That's where monsters lurk. When you're above the 200, it doesn't mean that it's all bright green, blue skies ahead. We could correct. But you don't get down 17% month or down 8% week at 52-week highs. It's very, very rare.
Okay, but this is but what I'm just saying is if you guys, and I don't know if you guys were in the markets in January of 2000, it really felt really toppy, and therefore we had this one last push in the NASDAQ, and people were disgusted by what's going on. And my point is that, yeah, the NASDAQ and the S&P over the next, call it 2 years, sold off, 50% and 80%, you know what I mean? From their highs. To me, that was the crash. crash. I mean, the crash was this slow-moving train wreck that went on for 2 years. Same thing in November of 2007 to the lows in March of 2009. I mean, that was the crash. Just because we didn't go 87 style.
But no, it wasn't. The top was November of 2007. The top was March of 2000. The real crash was later once those highs
the crescendo of the crash.
Here's what happens. The market tops. You don't know it's the top at the time. Right. It falls a little bit. It comes back but fails to come back to the old high. It falls a little bit more. It comes back. That's why tops look like they're rounded. Tops don't look like a knife's edge.
Yeah, tops are a process.
Tops are a process. So actually what it really looks like is a succession of failed rallies that do get you back up, just not back up to the previous peaks. And that can't happen more than 3, 4, maybe 5 times before fear sets in. Oh no, I may never see that old high again. That is the conditions under which a real crash, like condensed period of time, huge drop, usually coinciding with some blowups, that kind of thing, A, it's very rare. It does happen, but it's rare. And B, it almost never happens from an all-time high.
It happened in March 2000, and it happened in 1929. It did. But to Josh's point, this buy-the-dip mentality where you keep being rewarded for putting more money to work, that doesn't turn on a dime. That has to be unwound, much as it was in 2021.
The NASDAQ took 15 years to get back to those prices.
Back to your original point. This is the mistake that investors make. It's the number. I think it's the number one mistake, and it's actually the easiest. It's the easiest to talk about, the hardest to actually correct someone for making. Recency bias. The number one thing that investors do is reach for the solution to whatever just hurt them, and this makes sense biologically. If a fly is buzzing around your head all day, of course you want to swat the fly. If you put your hand on a hot stove and burn yourself, of course, you're never putting your hand on. So the recency bias is why everyone fights the last battle. And this is not just what happened last week. People fight the last battle from 2 or 3 years ago. There were still people worrying about an 08 style financial crisis up until 2018. Like it almost never went away. That's why last year, toward the end of the year, you had the worst year for bonds, the worst year for stocks simultaneously, maybe ever. That's why the 60-40 portfolio is dead articles started coming out December and January. And that's why every know-it-all in wealth management started overloading on alternatives. Anything but stocks and bonds. Fast forward, we're 6 months through this year. Bonds look great. Stocks look even better. So that is the biggest mistake. And the reason why it's the hardest to correct is because it always makes sense to worry about the thing that just happened. Now, we do it to the upside too. So anybody that was involved with NVIDIA, what's the next thing they want to do? Another AI stock. So we do it on both sides of the market, bull market and bear market. That is the number one enemy for all investors. I don't care if you're retail, professional, and I don't really know what to do about it other than read history and remind yourself. I know, but still, and remind yourself whatever's coming next probably is not going to look like what just happened. And if you can do that successfully, you will probably avoid a lot of the errors that most people are making, but you can't avoid them all.
Last time we talked about your client base and how not only are your clients interviewing you, but you guys are interviewing your clients, which makes the conversations, I would imagine, easier. But with that said, there's still difficult conversations. How did you miss X, or why aren't we in this type of thing? Are those conversations happening, or are you still people just very happy about it?
I'll just say setting expectations in advance is the only way to minimize the potential for that kind of stuff, but you can't avoid it completely. You have clients who are investing with you and then seeing stories about their next door neighbor who bought all this Ethereum, and so you can't completely eliminate it. It's not realistic. It's human nature to want what you don't have, to wish you got in on something. But the balance of that is, look at all the trauma that ends up happening and all the stuff that you weren't in, thank God. And I think that's the realistic way to approach the business.
Let me toot our horn for a second. So I think our advisors do a really good job making sure that they're bringing on fits. Now, it's very rare that somebody says, hey, do you guys do rules-based asset allocation with the tactical overlay and financial planning? Do you guys do that? Like, that's never happened before. right? So we do have to make sure, we do have to sell them that this is the right solution, all that sort of stuff. But what we do a really good job of, Josh and I and the team, is making sure that we bring on the right advisors. So we want the advisors and the clients to be a good match. We want the advisors in our firm to be a good match. So we're not bringing in people that are going to have difficult conversations with us repeatedly about put it this way, my advisors are not asking me questions about, hey, I'm worried about the market.
Introducing event contracts from CME Group for individual investors who want a new, less complex way to trade some of the world's most recognized futures markets. They're smaller, lower cost, with predefined risk. Event contracts let you trade your views on daily up or down price moves in equities, gold, oil, and more. The markets you know and use every day. Take a position by choosing a side with event contracts from CME Group. Learn more at cmegroup.com/event contracts.
iConnections is the world's largest capital introduction platform in the alternative investment industry. They bring the asset management community together through a membership platform that lets allocators and managers meet and connect both physically and virtually. Over 3,000 allocators and 600 managers are part of the iConnections community, overseeing nearly $48 trillion and $16 trillion in assets, respectively. iConnections first came to our attention in 2020 during the first wave of the pandemic. That's when their first event, Funds for Food, became the largest virtual cap intro event in history. To date, they've donated nearly $2.5 million to charities. They are also the people behind the alternative investment industry's largest and most exciting in-person events. To find out more about iConnections events and members-only platform, visit iConnections.io.
What's up? Guy here. Did you know FactSet is the official data provider for Risk Reversal Media? FactSet is the key to all of our analysis. It's not just charts. FactSet provides insight into the top headlines of the day, private markets, and sector-specific data. If you ever have issues, get help from their support team that is committed to your success. Visit FactSet.com to experience the power of FactSet and request a free trial and unlock access to the tools that matter most to you.
Hey, it's Dan here. Are you tired of struggling with your weight? I know I was. That's why I turned to Roe. They've developed a revolutionary medication approved by the FDA specifically for weight loss. It's paired with lifestyle coaching, so the weight comes off and stays off. I started with a free online visit and connected with a U.S. licensed healthcare professional. They prescribed the medication that's helped me drop 30 pounds in the last 4 months. And now Roe is offering a discount just for our listeners. To get our special offer, go to roe.co/tape. You'll pay just $99 for the first month and $145 per month thereafter. If prescribed, medication cost is separate. That's ro.co/tape.
Mention hiring. I mean, so that was first thing that came.
It's the hardest thing. Part of our.
Is it finding people, paying people, all of those things?
I think we're like one of the fastest growing firms in America. We've been for a long time. No matter how many people we hire, it's not enough for the amount of households that we're serving. And because the stupidest thing on earth you could do is go through all the trouble to onboard a great family, like meet these clients, their potential clients. We spend 3-4 meetings walking them through what we do before they come on board. It's very labor and time and energy intensive up front. It's front end loaded. You get through that whole process. You really get to know somebody, what they're afraid of, what they want, what the variables are, what the things we have to watch out for. You do all that work, the financial planners, my tax team, you do all that shit, right? You bring them on board, and then they don't have a good customer experience because you haven't adequately supplied trading staff to get cashiering requests done quickly. You don't have a client service associate to take their calls, respond to their emails, and you lose the client over that. It's insane.
So let me ask you.
We can't afford to not hire. The problem is I ain't hiring anyone. These are not just clients, they're fans. I need superstars at every role, and that is really hard
All right,
to do.
so here you go. So, and I don't want to do, I walked uphill both ways to school, but I was at Goldman Sachs from 96 to 03. I think when I started there were 6,000 people in the firm. Fast forward today, I think they're north of 40,000 people at the firm. So my question to you is, Goldman built themselves on culture. I would submit it's almost impossible to maintain that culture with that type of growth rate. You have a culture, but you're talking about hiring people. How do you maintain the culture? Both of you guys can answer that.
All right, so my quick answer is the number one ambassadors from us out to the world of clients and potential clients are the certified financial planners. Pretty much every single one of them who works at the firm joined because of the culture. They were already acolytes of what we're doing. We were not on LinkedIn trying to recruit advisors. We're not out there acquiring firms using private equity money. The people who work with us said, I read your stuff every day. I listen to your stuff. I love Barry. I love Michael. I love Blair. I read Ben. I like Josh. He's all right. But that's who works for us. So they're already part of the culture before they come. They're not part of the culture where they work now. They have to get the fuck out of there. And they're like, I would never leave this firm only for the chance to come work with you guys. And that means so much to me personally. And that's how we keep the culture.
Michael, how are people finding you? Because this is really interesting. We'll talk a little bit about Twitter/X. I mean, we all kind of met each other on social media going back, 10 plus years. And then you were on TV and you were
met
on
him
TV
on the set of Fast
50s.
Money.
But what I'm saying is how we found so many people. And I know your story and we talked about it last time. So I don't know about you guys. And this is really funny. Like yesterday, I literally just subscribed to your blogs again. You know why? I used to see all your posts on social. I'm not on Twitter anymore. Okay. And so it's an interesting, there seems to be a bit of a crossroads here for a lot of us. You got off Twitter years ago.
Way ahead of my time.
So how are people finding us?
So how are people, because I saw your post on the yield curve. I used to see that on Twitter and now, how are people finding you? And again, you guys are fairly prolific when you think about what you write, how you move it around on the web, obviously the audio and stuff like that. So has something changed for you guys in the last year or so?
So I will answer your question. I'm not trying to dodge. I just want to add one more thing to our culture thing because, guy, it's such a good point. Goldman spent 70 years or whatever it was building that, and when it goes, and it goes quickly.
You can't get it back.
And so we have an internal mantra that's not lip service. We really stick to this. If it's not an obvious yes, it's a no. From the advisors, because unwinding that relationship is traumatic for them, for their family, for their clients. And so we put these people through the ringer. And the proof is in the pudding because I think we've hired 24 advisors.
We've never let an advisor go or had an advisor leave us.
And an advisor has never left. And so we make sure that they're the right fit philosophically, culturally, personality-wise. I never want to lose the trust of my advisors. When we bring somebody in and we say they're good, we have that trust. They know they're good, but that's very fragile. It's ephemeral and it could go very quickly. And so we're going to do our best, Don, to make sure that happens. How do people find us? So I am tweeting much less. I'm only just blasting out links these days, but it's a podcast on YouTube and TV.
Yeah, well, we have subscribers. Keep in mind, Barry started his blog probably 03, 04, the big picture. It was on TypePad, if you remember that platform. They weren't even calling it blog yet, right? So he's got subscribers, a subscriber list that's been built for 20 years. I'm blogging 15 years now, 2008. Tadas works with us. 05, he started his site. Michael's site, Ben's site. These are some of the earliest and highest quality financial media products that exist. And I don't write as much anymore, but my following is still there.
Well, a lot of people disappeared. There's no payoff. And if there is a payoff, it's a long game.
You guys used to be funny. At first, no, the two of you guys,
you're not funny anymore?
They were funny on Twitter. You guys were kind of making a joke out of a lot of stuff.
Is Twitter a fun place to be funny?
Dan, building an audience is incredibly exciting and exhilarating, and you get the adrenaline and the dopamine. And then once you've built that audience, and even if it's a very, very small percentage of the audience turns on you, it's tough, right? To just take those barbs. You guys get it. Eventually you're like, all right, I don't know who needs this.
The worst thing you could do is be successful and having started with alongside other people who weren't. That's like the absolute.
And people want the underdog to win until they win.
It's okay. It happens. It happens all the time. It happens in every walk of life.
So why did you tried Threads and you were funny? I felt like it was Josh Brown, circa, I want to say 2015 on Twitter for like a week. And then I stopped using Threads.
Compliance. They don't have a solution yet that can adequately archive what I post there because their API is not open. So if I post something to Threads, somebody that works for me has to print it out and put it in a folder. It's just too much work. It's not worth it. I'm told there will be an API or some sort of solution coming from one of our compliance software companies, and maybe I'll go back. But yeah, I mean, it's when you could be fun, when you can have fun somewhere. So my brand is not. I don't talk shit about other people. I don't care what anyone else is doing. I'm not looking to go on social media to make someone else's day worse. I like to make people laugh, and I think I'm pretty good at it. There are environments where it's conducive to that. I don't think Twitter has been that for a long time.
Well, you said
way
that
before
to me
Elon.
2 years ago.
I said that to you 5 years ago.
Well, you did say it a long time ago, but 2 years ago, I remember going on your pod and you're just saying, like, listen, Instagram is a place where people go for this, and that is more conducive to what I want to be doing. And you were just done with Twitter. I mean, guy, you as a guy who literally like to spend a lot of time and engage with a lot of people, even your usage, your engagement must be down like dramatically, like 90%. We used to sit on the set of Fast Money tweeting back at people, and they loved that sort of stuff.
It was fun.
And
It was fun.
It's just over.
I'll explain what happened.
Yeah.
There was a wave of new users that came along.
It was a quote tweet.
Probably 20.
That's what ruined Twitter, honestly.
2018, 2019. All of a sudden, all these pseudonymous people with the word capital in their handle, they're basically like frustrated analysts at asset management firms or hedge funds. They think they're smarter than the PM. Maybe they are. It's like this endless frustration, and FinTwit is where they can go and be a superstar, and they can vent, and they could take out that frustration about their own career on other people.
Especially as people that are perceived as successful on Twitter who have large followings.
And you know what?
I guess what? They're definitely smarter than us, especially Josh.
And I was that person. I was sardonic, sarcastic. I thought everyone who was doing well, there was some trick or some. I was that guy, like in my own head. So I didn't act on it, but because I was always tweeting under my own name. I never had a fake name. But I get it. I understand that impulse. And you know what? You shouldn't go back. Like you shouldn't advance to a new level and then worry about what are the people that are still at the old level think. That's like who would do that? It makes no sense. So I just think like there will be new platforms in the future where it'll start over. It'll be fun. People will come back that haven't said a lot publicly. Maybe it's Threads. Maybe it's something else.
Is Threads too similar to Twitter to actually be the new thing? Do you know what I'm saying? Like, because I wonder, it feels like you're just on some,
Finance people need a chronological timeline, and if you don't give them that, they're not going to use that to express their market thoughts, because nothing is dumber than somebody thought something at 9 a.m. and it's 4 p.m. and there was a complete shift in price, and it's like someone else is going to see that thread post 2 days later. What is the point of that? So
I want to talk about your industry real quick because it's changing clearly, and you're at the forefront. How many I heard a number like 350,000 advisors in the United States. Is that ish?
No, it's that they're counting insurance brokers and
all right,
a lot of people that are not
throw a
advisors.
number at me. What's the proper
How many
number?
R's are there? 30,000?
18,000 firms. Almost all of them are barbershops.
Fair enough. So let me ask you this question: given demographics, the aging out of a lot of these advisors,
Yeah, that's the most bullish.
right?
But
what is
Guy,
your
they don't
industry?
age out.
What does it look?
They don't.
well,
they
don't
don't,
age
they don't
out.
leave. They just get worse at their job.
Yeah.
But they keep collecting the fee.
Listen, I'll say this: at a certain point, people do pass away, and my question is, what does the industry look like 5 years from now? Because you're working towards. That's what you're working towards.
So I'm going to tell you some secrets here. Number one, you know how they say like the actuarial tables, and they say like the life expectancy for, a female is 77 and a male is 76 or whatever they say. If you just do that with people that are in the top 1%, which most financial advisors are, those numbers go way higher. These people are living to like 93, okay? And they never leave, and they tell the kid that works for them they're going to leave one day, because that's what the kid has to do. The kid has to hear that so he could tell his wife.
The kid is 40.
The kid is.
I'm having these conversations. Their senior partner who promised them equity, they're not leaving.
Senior partner is 68 and is gonna never really leave unless some private equity firm comes in with a huge check, and even then they'll stay on and transition the client. So they're never leaving. It's a fantasy. That's number one. Number two, that's what the 40-year-old advisor needs to hear so he could keep telling his wife someday, and not be an entrepreneur or find a better situation.
But those people are getting wise to that.
How do you guys solve for that? Because that's
they're leaving.
They are
They're
leaving.
leaving.
We're hiring the best.
We're hiring them.
We're hiring the best Gen Y and Gen X advisors in America.
So the ones that understand that they're just being sold a bill of goods, the ones that have the culture already before even getting to the place whose culture, they're the ones that you're
finding.
finding.
Matter of fact, last time we were on this podcast, one of those people reached out to me and said, I heard you and Josh with Guy and Dan. You guys are my guys. And I've been basically sold a bill of goods.
So what type of finder's fees do we get? Hey, so
well, listen, this is important. We just did this in Wisconsin. We just did this in Austin. We just did this in Los Angeles. All this year, 3 rock star advisors. They're part of the team now.
So geographic is really important to you guys.
No. We're
really.
agnostic.
We want the people.
We want the best
but
people.
you guys have done that. I like watched over the years. You guys have hired small teams in San Diego, and like
we don't care where they are.
It's
It's the people.
By the way, the guy did not end up joining us, so thanks for that.
So no, but
I had nothing to do with it. You looked at me when you said that. I had nothing to do with it.
Can we? All right, Josh. Anything else? Because I want to talk about one more thing.
go ahead.
So I just want to make this distinction because we spoke earlier about the market, frothy, getting cautious. The market has earned its frothiness because the fundamentals are kicking ass. Ooh. Companies are beating.
Did you write this down? Because
No.
you're rushing it a little bit.
It's hot though. That's
Josh,
hot.
what am I looking at?
Is this going to be
kidding around.
Is this going to be the
I got a
social
chart
media
on. I got a chart on it. I'm looking at.
it is, right?
I'm looking at IWM.
It's going to be heavy. What is
No. So companies are beating and they're raising, and there's no incentive for management to forecast good news in the future quarters because then they have to actually go ahead and do it. And so the economy's good. Companies are on fire. I feel like everything it's a double beat and a raise. I feel like it's just and not just anecdotally. I saw a stat yesterday that the number of companies beating is a little bit higher. What it's like 73%, normally it's 68, whatever it is.
Like 77%.
But the magnitude of the beats, they're beating by like 560 basis points on.
If I said to you in December when everyone was bearish, myself included, everyone,
up.
It was rational to be bearish. By the way, if I said to you, this is what we're going to be talking about in July, earnings estimates are now going higher, not lower, right? Some of the key companies that make up the largest index weights are blowing it out.
Caterpillar.
Okay, hold on. So you have that. Home prices, I know you thought they'd be falling. Actually, now they're rising again, 4 straight months of rising home prices. Wealthy people with huge cash balances are now earning 5 or 6% on that cash. It's making them feel even wealthier and spend accordingly. Like if I lined these things up for you and then I said, what should the market be doing in that environment? You'd say, well, that sounds pretty. Oh, by the way, labor costs are slowing down. All the cost of everything is going down, right? Like if I gave you all of that stuff, you would, and oil hasn't spiked to 200, like all the things that we were worried about, hyperinflation. So if I gave you that, you'd probably say, yeah, S&P should be up 10, 20%. That's where we are.
And AI, by the way. Like the NVIDIA guide from 7 to 11 billion, like.
Yeah, but if they don't do that again,
I agree.
it's fucking lights out.
Agree.
Hey, but let's just say this. So from an earnings perspective, so you talk about those beats. What we had towards the end of last year, we had estimates for 2023 come down. So right now we're looking at maybe a flat S&P, year over year.
This is what frustrates the bears, though.
No, that's right.
All that matters is they're going back
But
up.
you know what's really interesting? There was an article in Bloomberg yesterday talking about hedge funds degrossing. Okay, like so basically taking their shorts down and taking their longs down for a whole host of reasons, right? And so I guess the one thing that I would say, what I think that a lot of the bears, me included, late last year, were not anticipating maybe just the excitement around the IRA, the CHIPS Act, all this sort of stuff from a fiscal stimulus standpoint, right? And then right around the time that we were talking last, we also had this regional banking crisis where liquidity came back into the market. Where did it go? Into some of these biggest names, right?
QE
right.
theory.
Yeah. And so we're not, it's not really a theory. It's just like the balance sheet of the Fed came down from 9 trillion to 8.4, and then we put a few $100 billion in monetary. And then we also had the backdrop of the fiscal, right? And then a lot of these inflationary inputs came down pretty dramatically. But one of the things that I think could change the tenor of the market would be if we just hit peak margins, okay, at a time where input costs are coming in, that might be the thing because a lot of companies were able to pass through higher costs, right, to consumers and enterprises.
But isn't that bullish? Like the costs are going to come down, the prices are not.
It is bullish.
Margins could expand paradoxically.
So here's the thing that like going back to late 2018, listen, we have these sort of mini crashes, if you will, because the S&P did drop 20% in 2.5 months in late, and it happened when people least expected it. And it happened at a time where people were like relying on China as this engine of growth and it slowed down, right? So all of this stuff could happen again. I'm not saying that you have to reorient your entire investment.
Well, then here
thesis,
we are. Right now, on August 1st, this is a complete 180 of what it looked like on January 1st, where everybody was bearish, everybody. Here, now we have, I just saw this in Bloomberg, net call volume jumps to the highest level since late 2021, and the cost of buying a put has fallen to the lowest level on record. Okay, so everybody is bullish because of the recency bias. So yeah, things have changed a lot.
Can I say one closing thing, though, that I think is like the biggest thing? This is what I think is the biggest thing. This could be a book. I'm not going to write it. The traditional financial media in which we all play a pretty outsized role, right? So whether you're talking about the Wall Street Journal or Barron's or CNBC or Bloomberg TV, the firmament, it's geared towards serving news to boomers, not on purpose. The boomer audience was in their 40s when all this stuff started, and like they grew up with, right? This is what they grew up with. So, and the media loves them and they love the media, and that relationship is like a nice relationship. And so because it's catering predominantly to people who are in their 60s, 70s, and now early 80s, a market falling down is bad. A market rising is good. This is an audience that all of the money they're ever going to have, they've already made. They can't replace it. They're not going to go back and get another job. So to them, rightfully so, a falling market is a negative thing. I speak to that audience. I'm really good at speaking to that audience. I love that audience. But I also speak to the millennial audience, of which I am a part. I'm either the oldest millennial or the youngest Xer, depending on who's dividing the line. It's 73 million millennials and 69 million Gen Xers right now in the workforce, in their peak earnings years or headed that way, forming families, putting money into 401ks. Explain to me how a flash crash, a stock market down 20% for any fucking reason.
I get it.
Explain how that's bad. If you are 30, 35, 50, 55, 60 even, if you are a forced saver and you have to invest every year into your IRA, into your 401k, how is down 20% bad? Unless you tell me you just got your last paycheck and that's it, and you will never make any money again and everything you have is fully invested in stocks, it's not bad. It's good. It's great. You actually should be rooting for it. Why, at 30 years old, do you want to take your parents or your grandparents out of their stocks at all-time highs? Right. Why do you want up?
No, we talk about that actually. We say it differently, but we're saying the same thing.
But this is the number one thing that the traditional financial media, they want to talk to the younger generations, but it's a different language. And they don't know how to cheer for buying opportunities because they're also still talking to the OG audience of people in their 60s and 70s. And it would be really off-putting if somebody that's 75 years old turned on CNBC in the middle of a 10% correction and some asshole like me were like, this is awesome. Everything. But that's how I feel inside. I can't express that because it's inappropriate.
Well, what you've said is what we've said for a while, that we've conditioned an audience to think that these adjectives, the market's up, it must be good.
That's right.
The market's down, it must be bad.
That's right.
And I've said this for years.
And it's not intentional. It's just how it is.
But we missed out a little bit on the nuance of this, Michael. You suffer less of this because you don't have to show up 3-4 days a week and put on a show. And I'm not saying we're putting on a show. I mean, like, we are all being very sincere and we get nuance. We've been in the business a long time, and a lot of people who are turning on the TV, they do want to be a little bit entertained, but they just got out of the dentist chair, or they're a lawyer, or they're an engineer, or they're a teacher or something like that. And they're there just to get a few pearls of wisdom from people that they enjoy watching and they trust and that sort of thing. And that's one of the reasons I think all of us enjoy this medium, because we get to have these conversations. And your 3,000 words on Uber, which wasn't just about Uber, it was really a masterclass in how to think about
life
big
when you
trains.
think about it.
No, I know. A very special edition episode.
All right,
of
before
On the
these
Tip.
guys
No,
get
but it
outta
was
here.
great. I mean, like, so, listen, again, I just want to kind of reiterate our listeners who are not following Josh at The Reform Broker or Michael at The Irrelevant Investor. These are two great blogs that are not not suffering from some of the things that we just went into about it. But
Michael Batnick's a Knicks fan. You are as well.
Yeah. Hell yeah.
Give me your starting five. I want your all-time Knicks starting five.
So like,
All-time
wait,
Knicks.
like for
My position?
my
Nick.
lifetime.
Yeah, you're putting together a team.
All right.
All right, Ewing.
Patrick's at the center. Please continue.
Oakley at power forward.
Wow, I like what you did there.
I mean, I'm not a Melo guy, but how could you put anybody else?
No, Melo is not on my team.
I want Latrell, though.
I didn't watch Bernard King.
What about Strickland as your point guard?
He was not on the Knicks for that long.
Mark Jackson.
No, Jalen Brunson.
Okay.
Jalen.
You
Jalen
taking
Brunson and Allen Houston at the two.
let me tell you something about Oakley. I was at, our friend, you guys know Brent Montgomery, Wheelhouse. Okay, he had Oakley. He was making fried chicken. He's like a chef now or something like that. And it was absolutely amazing. So we got to figure out how to get Oak to make us.
Where does he make fried chicken?
Well, he's got a
restaurant.
Yeah, well, he's doing like some catering stuff and everything.
dude.
He was. I'm gonna hook this up. I'm gonna get Brent and Starks was there, and like you guys would have been in heaven. So I know
Starks is maybe my sixth man.
you've never
you've
never turned down.
not
a piece
particularly talented, but probably the most.
Think
heart
about
of
the
anyone
career.
ever.
turned down a piece
Think
of fried
about the
chicken.
No, I
career
have
of
not,
John.
no.
The guy was bagging groceries, and he's become a beloved ex-Knick. I mean, think about that 4 or 5 year period of time. Back out that Game 7 in Houston, which
for
was a
18.
fucking disaster. I mean, Starks was the man.
Yeah,
that
still
dunk
is.
over Jordan. That's like
posterized Jordan. Almost nobody else has ever done that.
ever.
No. So
Gotta love the guy.
We started on
by the way, I
inverted
was
yield
there.
curves.
There was a playoff game where they honored the 1973 team. It was the anniversary.
Yeah.
This past season.
Yeah, I saw it.
And they had a whole ton of like ex-Knicks, not from that team, but just period. The ovation for Starks was,
Unbelievable.
listen to me now, 2x louder for any other person on the court, and they were all there. There's something about that like grit, that determination.
He's New York.
That I see myself more in Starks than Jalen Brunson is a freak. He's one of the best players that's ever been on the team. I don't see any of me in that. I see me in somebody like maybe Oakley, but definitely Starks.
I see a lot of myself in Kurt Thomas.
I'm more of a Jerry Lucas guy.
More of a Jeremy Lin guy. All right, listen. On that note, guy,
I see a lot of I see a lot of Van Gundy in you. I have to say. Look at how you've coached us to a successful podcast.
I see what you've done. All right,
well done, gentlemen.
Listen,
Thank you.
let's do this again. Let's do it every quarter.
Love to.
Come down here. Thank you. To
love you
Michael
guys. We'll
Batnick
come
and
anytime
Josh
you invite
Brown.
us.
This was a lot of fun, guy. Adami.
Absolutely.
We missed Danny Moses. He'll be back next week.
We don't have room for him though.
we
Actually,
do, right
is there-
here.
You can put somebody there. It's a fancy desk.
Danny would be listening to our bullish whatever, just like
his eyes would
just
be
like
bleeding.
rolling his eyes.
Well, he'll be here next time. All right,
Shout out
guys.
to
Thanks so
Danny.
much for being here.